Think back to 2008 and try to remember, or really try to feel what you felt when the market crashed by 50%. What were those feelings that you went through? In today's episode, we're going to discuss those.
Jim, one of the best things about Americans is we have very short memories.
What? We'll change it.
Jim, one of the best things about Americans is we all have very short memories. And that's good when we're trying to forget about things that were bad, things that hurt us, whether it was physically or emotionally. And one of the things we like to talk to clients about is you really can't have too short of a memory when it comes to looking at what's happened with your money. And when you talk about things such as the 2008 financial crisis, when the market dropped about 53%, that was a very tough time, but it seems like so many retirees have forgot about that because they're out on the edge risking everything again. So what do you think about that?
Well, the key point here, Dan, has been almost 9 years since that crash, and people, as you mentioned, have short memories. What they don't really understand, there's been 13 of those major crashes since 1930, one every 7 years, of a crash of 39.5% or greater. And if they don't prepare correctly for their retirement will be substantially different than what they envision, or they'll have to continue to work during retirement.
So go back to those statements you made there. So there's a market decline or crash of 39.5% every 7 years since 1929, 1930, every 7 years. Well, we're 9 years into this bull market, so we're 2 years past that ticking time bomb clock, which to me, that means we owe the bear money. The bear markets, we owe them money right now.
That's right. So if you have, let's say you retired today and you have $1 million in your portfolio, and you anticipate, because you've gone online, you talk to your broker and get a 7, 8, or 9% rate of return. What if your portfolio loses half of its value? How are you going to successfully get through retirement? You're not going to. No matter what your broker may say to you, it's not going to work.
Well, with that statistic you gave there, what if they lose 50% of that million and they wanted to get a 7% rate of return? That means they really have to get a 14% rate of return just to be back at even based on their $1 million figure.
Yeah, what a client may not understand is that if you lose half of your portfolio, 50%, you don't need a 50% rate of return to get back to even. You actually need a 100% rate of to get back to even, which is very, very difficult to achieve unless you're super aggressive and you live a long, long time.
That's tough. That's tough. Well, based on what you just said there, if you have $1 million and you lose 50%, we're down to $500,000.
Yeah.
If you make a 50% gain, you think you're back to even. You're not. 50% gain on $500,000 brings us back to $750,000. We're not even whole. You have to make a 100% rate of return on that $500,000 to be back up to even. You haven't made any progress. You just barely got back, scraped back to even.
You know, what's an important point that's coming out of this conversation, Dan, is that we every single day see at least 3 to 5 new clients. And each one of them don't think they have very much risk in their portfolio because they've told their advisor, I don't want a lot of risk. We have outside resource engines and platforms we use, third-party data, that we actually can take all of their funds, all of their stocks, all of the bonds. We can actually get a third-party company to come back and tell us how much risk they actually have in their portfolio. It's amazing that almost every single client has anywhere from 30 to 50% risk factor. In other words, if the market goes down by 50%, they're going to lose 30, 40, 50, or even 60% of their portfolio. They have no idea.
So basically it goes back to the same risk they had back in 2008, they're taking now, and if they can remember how much pain they went through when their portfolio of $1 million dropped to $500,000, what did they feel? You know, did they feel successful? Did they feel that everything was going to work out? Or did they feel the opposite? Anxiety, worried, couldn't sleep, spouse really worrying, wondering when they can retire. Maybe they couldn't even retire now. If your portfolio drops that much, how can you retire as planned? It's impossible. You can't retire with the same amount of income. You have to remember those pain issues. Could you help your kids and the grandkids with college education during that time period? Could you buy that new house? Could you do the remodel? Could you continue to plan to buy that new car? You can't do those things. You have to remember that. You have to remember the pain you went through to make better decisions in the future, because pleasure doesn't teach us anything. Right. It's always the pain.
That's right. And clients with their current brokers, the brokers will ask them, are you conservative, are you moderate, are you aggressive investor? And the client has checked one of those boxes at some point in time. But that means nothing. That means nothing to our firm whatsoever.
So how about when the clients come in and they check conservative or moderate, those types of clients that came from outside firms, how much risk does a typical client still have? Even if they think they're conservative or moderate, how much could they potentially lose right now?
Half their portfolio. And unless you can dial in exactly how much money somebody's willing to lose, and that's where we start from there. We don't care if this client says they're moderate or aggressive or conservative. That doesn't mean much to us. What means something to us is how much is that client willing to lose in the next major crash That's our baseline. That's how we start.
So what happens when you show them that they could lose 50% of their $1 million or $2 million assets if we have another 2008? They didn't know this. What's their reaction? The husband and the wife, what's their reaction when you tell them that?
Pure shock every time. They have no idea. They've been told differently by their advisors. And Dan, this doesn't happen once or twice. This happens on 95% of every client that we meet for the very first time.
Well, you and I had a conversation last week, and I had some clients come in. We discussed with them how much risk they had. They had 53% risk in their portfolio. And they literally, once they found it and we documented and showed them, they literally started shaking because they knew it was true, and they never wanted to feel that way again because it brought them right back to 2008 again, and that's what we're trying to avoid. So you have to remember, make sure you focus on remembering what has happened in the past and stay away from every single negative aspect. Make sure you remember the pain you went through when the market crashed, and you'll have a lot better financial security in the future.
In the end too, make sure that if you have an advisor, if you don't come in and get a second opinion from our company, that you have that advisor put in writing for you exactly the risk you have inside your portfolio. Not that you're a conservative, moderate, or aggressive investor. How much risk you actually have in that portfolio. Make them validate that with outside third-party resources. You'll be much better off.
If you like this video and you'd like to learn more about how you can set up your own second opinion to maximize your financial security, we've just created a brand new training video. Click the link below and we'll send it out to you right away.